Everyone's staring at the price chart, but they're looking at a ghost. The internet is flooded with $10 HBAR predictions, yet as of mid-February 2026, the reality is a humble 9 cents. Now, the gap between where we are and where the Moon Boys want us to be isn't a hill, it is a mountain range. Now, to most, that $10 target is just a joke. It's a mathematical prank played on people who don't own a calculator. This visual, though, it compares the flat-lined retail interest with the vertical spikes in transaction volume. While people stopped talking about HBAR, the ledger quietly crossed 71 billion total transactions. It shows that network activity has completely decoupled from public hype. You see the impossible market cap required for a 100-fold gain, and you'll just simply walk away. That's the logical move, right? But while you were looking at the price, the fundamental pipes of the internet were being replaced. We aren't just talking about trading tokens anymore. We've moved into a phase where the ledger is a tool for machines, not just a playground for retail investors. A $10 HBAR is a mathematical fantasy for anyone who understands basic market cap constraints. The critics are right if you think HBAR is another coin. But the data that I uncovered points to a massive pivot. We've entered the era of agentic internet. This chart tracks the rise of the autonomous AI software agents, and these machines, they don't care about the price. They only care about consensus speed. They are now driving millions of microtransactions per day to settle data on the HBAR consensus service. This is not speculation, it's machine-driven demand. The realization is disturbing because it means the old way of valuing crypto is officially dead. If you're still waiting for retail investors to pump your bags, then you've completely lost. The real pressure is actually coming from the machines. You've been told market cap is a ceiling, but in reality it is just a lagging scoreboard. The most common argument against a $10 HBAR is the trillion-dollar wall, the idea that for HBAR to hit that price, it would need a market cap larger than most of the world's biggest companies. But this logic assumes that market cap is a physical limit on how high an asset can trade. But the secret is that it isn't. Market cap is simply a byproduct of the last price paid multiplied by the total supply. It does not tell you how much money is actually in the system. It only tells you what the crowd thinks the system is worth at this exact second. This visual deconstructs the market cap formula to show the liquidity vacuum. It demonstrates that it doesn't take trillions of dollars flowing into HBAR to raise the market cap by trillions of dollars. It only takes a lack of sellers at current price points. When the sell side liquidity dries up, even the most modest buy pressure from enterprises or ETFs, it can force a violent upward price discovery because the price is forced to jump to the next level of available sellers. You see, retail investors, they fall into this trap because they treat crypto like a closed loop of retail money. They look at the $3.98 billion valuation and they think that it's just too big to move. But they are ignoring the fact that liquidity is what actually governs the price. If a large enough portion of the 50 billion token supply is locked away in staking rewards or held by governing council members or utilized for enterprise nodes, the available supply for trading becomes much smaller than the headline number suggests. Market capitalization is a lagging indicator of perceived value, not a forward-looking constraint on utility-driven price discovery. Now, we have seen this play out before with assets like Nvidia or even Bitcoin. Critics claimed that they had reached their caps based on previous cycle highs, only to watch them smash through those ceilings once the institutional utility and scarcity took over. HBAR is moving into a similar phase, where its value is being dictated by its role as a required commodity for global infrastructure, not just a speculative token. This chart provides a comparative analysis of the ceiling breakers. It shows how assets like Bitcoin and major tech stocks exceeded their theoretical market cap limits by shifting from retail-only speculative assets to institutional-grade utilities. It maps HBAR's current trajectory onto the same path, highlighting the transition from the $3.98 billion retail base to the potential $1 trillion enterprise utility phase. When you stop viewing market cap as a barrier and you start seeing it as a reflection of the network's velocity, the math for $10 changes completely. The impossible valuation isn't a prediction of how much retail cash will enter the market. It's a projection of the value generated when billions of automated transactions require HBAR to function. While you were sleeping, Hedera quietly became the most used ledger on the planet. While the rest of the market argues over white papers and potential, the HBAR mainnet is already operating at a scale that makes traditional blockchains look like dial-up internet. Now, we aren't just talking about a few thousand swaps or NFT mints. We are talking about a network that has processed over 71 billion total transactions since its inception, a number so large that it effectively resets the baseline for what a successful distributed ledger looks like. This visual provides a throughput reality check. It places Hedera's real-time average of 1.5 million to 2.7 million transactions per day side by side with the slow giants of the industry. The graphic highlights that Hedera isn't just winning here, it is operating on a different dimension of data velocity, dwarfing its nearest competitors by sheer magnitude. This is not retail hype, it is the engine of the agentic internet. Now, we have entered a paradigm where millions of autonomous AI software agents are using the Hedera Consensus service to settle data and manage secure low-latency microtransactions. Now, these agents, they don't care about the price volatility or Twitter sentiment. They only care about finality and cost. By providing a fixed predictable fee structure denominated in US dollars but settled in HBAR, Hedera has given corporations the economic predictability that they need to move from experimental pilots into massive mainnet production. The goal has always been to create a decentralized public ledger that offers the security of a private network with the transparency and reach of a public one. The efficiency of this gossip about gossip protocol allows nodes to reach a consensus timestamp through virtual voting, achieving the theoretical ceiling for security known as asynchronous Byzantine fault tolerance. It is the technical foundation that has attracted the world's most risk-averse institutions to the governing council. This visual explains the fee predictability as a market moat. It shows how Hedera's model of pegging fees to the US dollar, averaging as low as 0.0008, protects enterprises from the gas fee spike that plagues other networks. It demonstrates how this market makes enterprise budgeting possible, transforming HBAR from a speculative token into an essential commodity for global data infrastructure. We are watching a fundamental shift where HBAR is transitioning from a bet into a required fuel for a global machine. Every time an IoT device tracks a supply chain or an AI agent verifies a data stream, HBAR is burned. Now, the utility is no longer a theory, it is a 71 billion transaction fact. And this raises a question for you. Why are the world's biggest corporations building on a network that retail market is ignoring? If this technology is so perfect, why isn't HBAR already at $1? It's the question that keeps skeptics loud and the HBAR-barians frustrated. Now, before we look at the path to $10, we have to look at the friction. Now, it's important to note, I am not a financial advisor. The crypto market is highly volatile and speculative. This content today is for educational purposes only. You should always do your own research before putting any capital at risk. Now, the truth is that while the tech is moving at light speed, the institutional world moves at a pace of a glacier. Now, we've seen high-profile exits like Boeing from the governing council and a brutal regulatory gauntlet that has stalled the very catalysts investors were banking on. This visual maps out the ETF regulatory gauntlet of early 2026. It contrasts the momentum of the Canary HBAR Trust with the sudden withdrawal of Grayscale's HBAR ETF application. The graphic shows the shifting deadlines and the specific SEC information requests that forced institutional players to pause. highlighting why the wall of money hasn't hit the ledger just yet. The grayscale withdrawal was a gut punch to retail sentiment. It signaled that even with 71 billion transactions, the legacy financial system still hasn't fully figured out how to categorize a decentralized ledger governed by a council of global giants. Now, this red tape creates a price ceiling that has nothing to do with the math and everything to do with politics. When big money is told to wait, the price sits still. The regulatory path for digital assets remains a gauntlet of shifting goalposts that are fundamentally unfair to innovators. This lack of clarity trickles down into how the network is perceived. When a founding member like Boeing rolls off the council, the FUD machine goes into overdrive, claiming the enterprise experiment has failed. But the reality is far more nuanced, right? It's an evolution of the guard, right? We are seeing a transition from the original legacy partners to a new generation of infrastructure players who actually use the ledger for daily operations. This visual tracks the council seat dynamics from 2019 to 2026. It highlights a departure of Boeing and the entry of Arrow Electronics, showing the shift from brand name partners to utility-first partners. It calculates the total revenue generating potential of the current 31 active council members, proving that while the names change, the economic footprint of the council is actually expanding. The institutional red tape is real, and organizational transparency at the foundation has faced valid criticism. But as we've kind of seen in every other cycle, friction is usually the prelude to a breakout. Now, the question isn't whether the big money is coming, it's whether you'll still be holding your HBAR when the red tape finally snaps. Hoping for $10 is a gamble, but building a redundancy strategy is a career. Now, if you've been in this space long enough, you know the most dangerous number is one. One exchange, one wallet, one single point of failure that can wipe out your entire portfolio before the price discovery even starts. Who remembers FTX? Anyone? Right, most people treat crypto like a casino, but the professionals, they treat it like a mission-critical infrastructure project. You don't just buy HBAR, you build a fortress around your access to it. Now, this is why I'm an advocate for the redundancy strategy, a systematic approach to ensuring that you never lose your seat at the table. This layout visualizes a professional 3-tier exchange setup. It shows how diversifying across multiple KYC'd accounts prevents a single regulatory or technical glitch from locking you out of your liquidity. The visual emphasizes that redundancy is the only real insurance policy in a market that never sleeps. The goal is not to just survive, it is to thrive while everyone else is panicking. To master this, you need the right environment. Now, we've built the Cheeky School and our free Discord to give you the exact blueprints for this setup. Use the links in the description down below to join our Discord or take part in some of the courses available over at the Cheeky School, specifically the free course around crypto safety, right? Because you've got to stop treating crypto like a gamble or a casino and start treating it like a proper business. Now, we focus on the how so that the what doesn't destroy you. Risk management is not about avoiding risk, but about managing the risk that you take to ensure you stay in the game. Now, a part of that management is picking the right partners. For me, Kraken is a reputable exchange that offers professional edge. While others are fighting for scraps, Kraken provides a reliable choice for executing these high-stakes trades. Plus, using the link that you'll find on my website, which you'll find a link for in the pinned comment down below, you can actually pick up a 3% cashback on your cash and crypto deposits, up to $1 million. A small edge that actually compounds massively over time. This graphic breaks down the Kraken advantage. It shows the math behind a 3% cashback model on a growing portfolio, demonstrating how this professional's edge offsets trading fees and builds a larger position over time. The meaning is clear. Every percent saved is a percent earned towards the $10 target. The redundancy strategy is the boring part that makes the exciting part possible. It's the floor that you build so that you don't fall through the cracks when the market starts to move. Check the pinned comment down below for a link to my website, where I list all of the exchanges that I personally use and that I think are the most reputable. Check them out. HBAR isn't a stock that you buy, it is the gas of a global machine that must burn to function. Now, while retail investors obsess over green candles, institutional scale users are calculating their HBAR requirements for the next 5 fiscal years. Now, we are witnessing a fundamental reclassification of the asset. By early 2026, the market is beginning to realize that Hedera's value isn't derived from vibes or community memes, but from its role as an essential fuel for the agentic internet and global data integrity. Every automated process on the ledger requires HBAR to power its movement, creating a constant, non-speculative demand that traditional crypto assets simply don't possess. This visual illustrates the throughput to revenue engine. It maps out how Hedera's low USD-pegged fees, averaging just 0.0008, are a strategic moat that attracts massive volume. The graphic shows that while a single transaction is cheap, the sheer velocity of 1.5 million to 2.7 million transactions every single day creates a massive recurring buy pressure on the underlying token. It proves that in the enterprise world, high volume beats high fees every time. The core of this demand lies in the Hedera Token Service, the HTS, and the Consensus Service, HCS. Now, these aren't just technical terms, they are the plumbing for the next generation of finance and logistics. As of mid-February 2026, the network has crossed the 71 billion transaction milestone, a feat driven not by human traders but by the machines. From supply chains managed by new council members like Arrow Electronics to energy identity solutions from Repsol, the ledger is becoming an inseparable part of the corporate tech stack. This creates a floor of buy pressure that is independent of retail sentiment. The shift toward real-world asset tokenization and institutional DLT adoption is no longer a forecast. It is the current operational reality for global ledgers. This institutional positioning is exactly why the network is currently dominating the real-world asset RWA space. While other chains struggle with unpredictable gas spikes, Hedera's predictable cost structure allows a company to tokenize billions in assets with a fixed budget. We are moving toward a world where the token isn't the product, it's the utility that is the product, and HBAR is the only way to pay for it. This 2026 RWA pipeline chart visualizes the massive scale of assets currently being tokenized on-chain. It highlights the asset tokenization and stable coin studios as the primary drivers. The graphic shows the growth of institutional initiatives such as the Saudi $200 million fund and Qatar $40 million initiative, transitioning from pilot programs to full mainnet production. The meaning is clear. Hedera is capturing the value of the physical world, one micropayment at a time. When you stop viewing HBAR as a speculative coin and start seeing it as the required fuel for global data infrastructure, the path to massive price discovery becomes a matter of throughput, not just hype. The tech is about to get faster, and the supply is about to get tighter. As we hit the middle of February 2026, the Hedera network is quietly undergoing a metamorphosis. While the market focuses on price candles, the engineers have been rolling out the Dynamic Address Book, or DAB for short. Now, this isn't just a minor patch, it's the foundation for a network that can finally scale without limits. By allowing nodes to update their own credentials on-chain, Hedera has removed the manual friction that held back decentralization. We are now seeing the first true step towards sharding, which aims to push the network past 100,000 transactions per second. This finality speed test compares Hedera's sub-3-second finality against traditional banking rails and older blockchains. It shows that while the credit card swipe might take days to actually settle in the back end, Hedera achieves mathematical certainty in the time that it takes you to blink. Now, the value highlights that for global finance, speed isn't just about TPS, it's about how fast the transaction becomes irreversible. This speed is the magnet for the next wave of adoption. But a fast network is useless if it is governed by a chaotic crowd, and that is why the recent organizational shift is so vital. With the new era restructuring, the project has returned to its roots of permissioned governance. Led by the Council of 30 world-leading organizations, this isn't just about corporate names, it is about creating a stable environment where a billion-dollar company feels safe moving its entire operation onto a public ledger. The goal of the Hedera Council has always been to provide the most stable, secure, and decentralized governance model for the global digital economy. While the governance matures, the math behind the token itself is reaching a tipping point. We are currently sitting at over 90% of the total 50 billion HBAR supply either in circulation or fully allocated. The great acceleration of token releases has spooked investors in previous years, and it is effectively over. We are moving from an era of high inflation to an era of absolute scarcity. This tokenomics countdown shows the remaining unallocated HBAR supply shrinking towards zero. It contrasts the massive 2025 release schedule with the flatlining emission curve of 2026. The meaning is clear. The sell pressure from the treasury is drying up just as the buy pressure from enterprise usage is hitting its stride. When you combine a network that can handle the entire world's transaction load with a token supply that has nowhere left to go but into the hands of users, the result is a massive supply-demand imbalance. The stage is set for a breakout that has nothing to do with speculation and everything to do with physics. Now, all of this raises a question for you. What happens to the price when the ledger reaches full circulation and enterprise demand doubles? Let me know your thoughts in the comments below. We aren't waiting for a miracle. We are waiting for the math to catch up. The path to $10 is not a straight line drawn by a hype man. It is a convergence of three massive forces. First, the 71 billion proof points already on the ledger. Second, the demolition of the market cap myth. And third, the arrival of institutional money that is finally starting to bypass the red tape. Now, while retail traders are still arguing about charts, the Canary HBAR Trust is seeing millions in inflows, and the agetic internet is burning HBAR every second. This visual highlights the golden cross of value. It shows two lines, one representing speculative trading volume, and the other representing utility-driven transaction fees. In early 2026, the utility line finally crossed above the speculation for the first time. This demonstrates that the network's value is now being sustained by real-world use rather than just traders betting on the next pump. This shift changes everything. When the network itself becomes the primary buyer of the token to fuel its own operations, the price discovery stops being about who will buy your bag and starts being about how much fuel the global machine needs. We are seeing this reality play out on the global stage, where the conversation has moved from whether Hedera will be used to how fast it can scale to meet the demands of millions of automated agents. The rise of the agetic internet isn't just a tech trend. It's a fundamental shift in how global value is settled and verified. So, where does that leave us today? While the $10 target is the ultimate destination, the near-term data is more grounded. By the end of 2026, analysts are looking at a range between 18 and 35 cents for the first true test of this new utility model. It sounds small compared to $10, but it does represent a massive move in the network's value based on pure organic demand. This chart displays the 2026 forecast corridor. It maps out the projected price path from, 18 cents to 35 cents based on current ETF inflow rates and the 100,000 TPS sharding roadmap. It shows that even a realistic move is huge when you account for the sheer scale of enterprise adoption hitting the mainnet. The math, it doesn't lie, even if people do. Now you have the data, you have the strategies, and the tools to navigate all of this. Don't let a market cap number stop you from seeing the machine being built under your feet. If you want to see exactly how these AI agents are changing the game in real time, check out the video that is queuing up on the screen right now. I will see you all over there.